Think about the last time you bought something you actively hoped you would never have to use. You do this every single month when you pay for insurance. You hand over your hard-earned dollars to a giant company, and if everything goes perfectly, you get absolutely nothing back. If you have a great year with no car crashes, no kitchen fires, and no broken bones, the insurance company celebrates by keeping all of your cash. It is the only industry where the customer is completely happy to pay for a product they never want to see in action. We buy it because the alternative is terrifying. A single bad day could wipe out your entire life savings, leave you without a home, or put you in a lifetime of debt. This video is about how this strange arrangement actually works, why it exists, and how these companies make billions of dollars off our collective fear of the worst-case scenario. To understand how this works, we have to look at how humans have dealt with disaster for thousands of years. Long before giant corporations existed, merchants shipping goods across the sea faced a massive problem. If you owned one ship and it sank in a storm, your business was completely ruined. Some clever merchants in China realized they could solve this by spreading their cargo across many different ships. If one ship sank, everyone lost a little bit of cargo, but nobody lost everything. This is the exact core concept behind modern insurance, which we call risk pooling. Risk pooling is the process of grouping large numbers of people together so that the financial loss of one person is shared by everyone in the group. Think of it like a giant neighborhood fund. Imagine you and 100 neighbors all own houses worth $100,000 each. Every year there is a tiny chance that one house in the neighborhood will burn down. None of you has $100,000 sitting around to rebuild a house from scratch. You all decide to pitch in $1,000 every year into a shared bucket. By the end of the year, you have $100,000 in the bucket. When one unfortunate neighbor has a kitchen fire that destroys their home, you hand them the money from the bucket to rebuild. Everyone else lost $1,000, but they bought peace of mind knowing that if their house had burned down, they would have been saved too. This monthly payment you make to keep this protection active is called a premium. You are paying a small, predictable cost to avoid a massive, unpredictable catastrophe. If insurance was just neighbors helping neighbors, it would be simple, but the real world is much more complicated. An insurance company is not your friendly neighbor. They are businesses that want to make a profit, which means they have to be incredibly careful about who they let into their bucket. They do this through a process called underwriting. Underwriting is when a company assesses how risky you are and decides how much to charge you for your policy. To figure this out, they employ some of the smartest math geniuses in the world, known as actuaries. An actuary is a professional who uses math and statistics to calculate the exact probability of bad things happening to you. They know exactly how many 40-year-old men with red sports cars will get into an accident this year. They do not know if you specifically will crash, but they know the averages across millions of people. If you are a 20-year-old who just got their license and drives a fast car, your premium will be sky high. If you are a 40-year-old minivan driver with a perfect driving record, your premium will be much lower. The company is trying to charge you an amount that covers your expected damage plus a little extra for their profit. To keep people from making tiny claims for every little scratch, they introduce something called a deductible. A deductible is the specific amount of money you have to pay out of your own pocket before the insurance company pays a single dollar. If your deductible is $500 and your car repair costs $400, you pay for the whole thing yourself. This keeps the insurance company from wasting time on small issues and forces you to have some skin in the game. At this point, you might think insurance companies just sit on your money and wait for disasters to happen. That is not even close to how they actually make their billions. When you pay your premium, that money does not just sit in a bank account. The insurance company takes all that cash and immediately invests it in the global financial markets. This giant pool of collected premiums that has not been paid out in claims yet is called the float. The float is a massive interest-free loan that you and millions of others give to the insurance company. One of the greatest investors of all time, Warren Buffett, built his entire empire using this exact concept. His company bought insurance businesses because they provided a constant stream of cash that he could use to buy other companies. Even if the insurance company only breaks even on the claims they pay out, they make absolute fortunes on the investment returns from the float. It is a brilliant business model because they get paid today for a promise they might not have to fulfill for years, if ever. Of course, this system only works if the insurance company is incredibly disciplined about who they cover. If they make a mistake and have to pay out more in claims than they collected, they can lose massive amounts of money. This is why getting a claim approved can sometimes feel like trying to negotiate with a brick wall. They have a financial incentive to look at your claim with a skeptical eye. Every dollar they do not pay you is a dollar that stays in their investment pool, making them more money. When you introduce insurance into human society, people start behaving in very strange ways. Economists have a term for this behavior and they call it moral hazard. Moral hazard is the tendency for people to take more risks when they know they are protected from the negative consequences. If you have full car insurance with a $0 deductible, you might park in sketchy neighborhoods or drive a little faster in the rain. If you had to pay for every single scratch yourself, you would probably park at the far end of the lot where nobody could touch you. Insurance companies know this, so they have to design rules to keep us honest. This is also why our health insurance might offer you a discount on your monthly premium if you go to the gym or get a yearly checkup. They want you to stay healthy because a healthy person costs them less money. Another weird phenomenon is called adverse selection. Adverse selection happens when the people who need insurance the most are the ones who are most likely to buy it. If an insurance company sells health insurance and only sick people buy it, the company will quickly go bankrupt. To survive, they have to convince healthy people to buy insurance too.
This is why some types of insurance, like car insurance, are legally mandated by the government. By forcing everyone to buy it, the risk pool stays balanced with both safe and risky drivers. At the end of the day, insurance is a weird compromise we make with the unpredictable nature of reality. It is easy to feel frustrated when you look at your bank statement and see hundreds of dollars disappearing every month to a company that you hope to never interact with. You are paying for something you cannot touch, taste, or show off to your friends. What you are actually buying is the ability to sleep at night. You are buying the certainty that if your world turns upside down tomorrow, you will not have to rebuild it entirely on your own. It is a system built on math, human behavior, and the simple truth that we are all stronger when we share the load. Just remember that while they are helping you, they are also running a highly profitable business. Take some time to read the fine print, understand your deductibles, and shop around to make sure you are not paying more than you have to. Keep trying to survive this wild world of money, and make sure to consult with a licensed professional before making any major financial decisions.